Hey everyone, welcome back to Corporate Decoder. Today we're diving into the world of PVH CORP, the company behind brands like Calvin Klein and Tommy Hilfiger, to check out their recent report. It's got a bit of everything: loans, interest rates, and financial jargon. But don't worry, we will decode it all together and make sense of what it means for the company's future. Let's get started. So what's this report about? Well, PVH just signed a deal for a new loan. This isn't just any loan, it's what they call a delayed draw term loan facility. That basically means they have the option to borrow money up to $250 million when they need it, instead of getting it all at once. Think of it like having a credit line they can tap into. This loan agreement was made with several lenders, and Barclays Bank PLC is acting as the administrative agent. It is important because it gives PVH more financial flexibility. They can use this money for things like managing their day-to-day operations, which is also called working capital, or for other general business needs. Here's a key detail: PVH doesn't have forever to use this loan. They can borrow the money in chunks, but they have to do it before February of the next year. And each time they borrow, it has to be at least $50 million. The loan itself has to be paid back by April of the year after that. So it's a short-term loan designed to help them with immediate needs. They can also pay it off early without facing penalties, except for the usual costs that come with breaking a loan agreement. Now let's talk about interest rates. PVH gets to choose how their interest rate is calculated. It can be either a base rate or a term SOFR rate, both of which are methods to calculate interest plus an extra percentage called the applicable margin. The initial applicable margin is 1.12% for loans with the term SOFR rate and 1.25% for loans with the pays rate. They will also pay a commitment fee on the amount of money that's available but not yet borrowed. This fee starts 91 days after the deal was signed at a rate of 0. They will also pay a commitment fee on the amount of money that's available but not yet is doing. Financially, specifically their debt levels and credit ratings. This loan comes with some rules, also known as covenants. PVH needs to maintain a certain financial health, specifically a maximum net leverage ratio. This ratio is a measure of how much debt they have compared to their earnings. If they don't stick to these rules, they could be in trouble with the lenders. The credit agreement also lists the events that would allow lenders to demand immediate repayment. These include things like failing to pay, providing false information, breaking the agreement's rules, going bankrupt, defaulting on other debts, or a change in who controls the company. These are pretty standard for any loan agreement. So what's the big picture here? PVH is securing short-term financial flexibility. They have the option to borrow money as needed, but they need to be mindful of the deadlines, interest rates, and financial rules that come with it. This move could be to support their operations, invest in new opportunities, or manage their debt. Now, looking at this situation, PVH seems to be taking a proactive approach to managing its finances. The new credit line gives them flexibility. However, they need to carefully manage their debt and ensure they meet the financial requirements of the loan agreement. The fashion industry can be unpredictable, so having this financial cushion could be a smart move. One notable risk is that if PVH's performance declines, they might find it harder to meet the loan requirements or face higher interest rates. In conclusion, this new credit agreement is a tool for PVH to navigate the challenges and opportunities in the market. Whether it will ultimately benefit the company depends on how well they manage their finances and adapt to changing consumer trends. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.